Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Gold's great run is continuing, hitting record highs above $2,500 an ounce over the past few days. With so much uncertainty in the market, there's clearly an appetite for safe haven assets. But how far can it go? Vivek Dhar is the Director of Mining and Energy Commodities Research at Commonwealth Bank. Vivek, welcome back to Fear and Greed.
No, thank you.
Gold can't go any higher. I'm surprised it is where it is. What's the outlook for gold and why are we seeing it at these levels?
Sure. So look, I think the last time we chatted, we actually talked about gold getting to $2,500 an ounce as a level by the end of this year. Now, we are already there. And it just tells you how quickly gold has responded to current market conditions. And, this is a commodity that if we look at it throughout this year alone, it has been on a tear no matter what is happening in the macro backdrop. When the US dollar was strengthening, which is usually quite negative for gold found a reason to keep rallying. And that was on the back of central bank demand for gold. And now, as we're in this period where rate cuts are being priced into the market, because that's what's looking like the case in the US, gold has once again gotten favor and particularly gotten support as the US dollar has weakened. And so this is now the next rally leg for gold. And clearly the risk to our entire outlook is that gold is looking like it'll potentially go even higher than $2,500 an ounce and potentially finish at, say, something closer to $2,600 at the end of this Fed cut cycle.
It's a particularly fickle market for gold because you've just given the example where gold increased as the USD appreciated and then increased as it depreciated. It comes down to the fundamental that it's a safe haven asset. I'm still trying to get my head around why it's doing so well.
Yeah, look, in terms of historically, and if I look at it very recently, so let's take 2024 out of the equation and just look at the last 18 months, from the end of 2023, it was very clear that the US dollar and gold had developed a very close negative relationship. And the idea being that when we saw the US dollar increase, gold ended up being more expensive for consumers outside of the US, and therefore we saw gold prices effectively fall. Now, this market dynamic was very true for gold for a while. And then, as we have seen in the past, these relationships break down, and they don't just break down slowly, they just disintegrate. And this is why gold is such a, as you said so well, it is very fickle. And what drives it can be very hard to determine in the future. And so you're really relying on what has worked very recently. And so we definitely got a reality check this year, given that gold has just found strength in any market condition. And that's really what, for us has been a big tailwind and why it's very hard to stand in front of the momentum and say, oh, gold will stop here. It's just simply a story that these rate cuts and a weaker US dollar is really going to be the rallying cry for gold in coming months and potentially over the next 12 months.
It used to be unusual that gold was going to be above $2,000 an ounce. Now it's been there for months now. Broadly, do you think it can stay, you're talking about 2,600, but above that $2,000 level long term or not?
Look, I think gold should be treated more like a currency than a commodity. And so its level is less important than the factors that are driving its momentum. So when we look at gold, whether it's 2,400, 2,500, 2,600, where is it now and what are the macro conditions coming up? That will just create either, upward momentum or downward momentum. But generally we've seen that upward momentum build. But I wouldn't get caught up so much in, it's above 2,000, is it sustainable? This is trading more like a currency. And what we're seeing in the macro backdrop is that it's all supportive right now. So it can be sustained above 2,000. I think the question right now is how much above 2,000, and particularly, as we get north of 2,500, where will that momentum stop? And given our outlook for the US dollar to continue to weaken, we see tailwinds ahead for gold.
Stay with me, Vivek. We'll be back in a minute. My guest this morning is Vivek Dhar, Director of Mining and Energy Commodities Research at Commonwealth Bank. Moving on to iron ore, trading around $97 a tonne. It hasn't sort of been at this level. It's been at this level, but really consistently at this level for about 4 years or so. Jim Chalmers, the Treasurer, came out and said it would cut the bottom line of the budget. Why is iron ore relatively cheap now compared to the last 4 years at least? And what's the outlook for that commodity?
Sure. So look, if I had to look at what we track for spot prices, we're actually closer to $90 a ton. So right now we're just south of $92 a ton. And this compares with earlier this year, we saw prices peak at about $144. So we have seen iron ore come off quite a bit in this year alone. So this has been really the big driver. And while we've seen iron ore flirt with going below $100 a ton, we have now seen it sustain below that level for now a number of trading sessions. And that has alerted market attention because you've broken through a key barrier point. And now everyone is asking, how low can we go? Now, to get to the bottom of that, it really comes down to what has driven it to these levels. And it is coming from very weak Chinese steel demand. You know, we've talked previously, but the problems with China's property sector aren't going away. You know, there was an entire expectation that policymakers, and there were announcements in May, where they were going to intervene and put funding towards purchasing excess inventory, converting that to affordable housing. And markets back then were optimistic that maybe policymakers have the right policy now to stabilize a sector that accounts for about 30% of China's steel demand. But what has become quite apparent is they're not funding that package as well as what the market needs it to be. And that has meant that the optimism has turned now to pessimism, and the property sector continues now to be a headwind for China's steel demand. But what I think the market didn't expect is infrastructure, which is about 25 to 30% of China's steel demand, that has also turned south. And the fact that we now have both infrastructure and property heading downhill, it has pressed on iron ore significantly. And it is this pressure which is really what is galvanizing iron ore closer to $90 a ton, and have people worried that how weak can these two sectors get? Because the more it does, the closer the risk is that we get even below $90 a ton. And if we look at iron ore prices since the beginning of 2019, whenever we have a severe down cycle in any of these kind of cyclical moments, $80 a ton is where it usually bottoms out and then sharply jumps. And so in the near term, we're thinking $90 a ton would be its bottom, but clearly the risk is $80 a ton. And so we're watching this space very, very closely, but this is only temporary. Our view is that we will return back above $100 a ton once it becomes clear that we cannot have a Chinese economy that is bleeding in its property and infrastructure sectors. They are such important parts of China's economy that we need to see them turn a corner, and we expect policymakers to provide that support, because they are not going to get their growth to about or around 5% this year if we continue to see what's happening in infrastructure and property persist for the remainder of 2024.
Okay. Last one, oil. We talked about gold being fickle. Vivek, I reckon oil's even more fickle, if there is such a thing for commodities. It's trading under $80 a barrel. Considering the tension in the Middle East, how susceptible are we to big moves in oil prices?
So look, I think oil is one that has been generally range bound as between $75 and $85 a barrel. And this has been almost a play for the most part between demand concerns, particularly out of China, which is pressing on the lower side. So you push towards $75 a barrel. And then you have OPEC Plus, which controls, we're talking 45% of supply. They're curtailing production in order to support prices higher. And that helps you up towards that $85 a barrel. Now, this tension has been there for a while. It's the reason why we're so range bound. But where all that positive risk and where markets have been worried is what happens in the Middle East, post this Israel-Hamas war that began in October 7 last year. And how that tracks and the concerns over that, oil markets certainly only pay like 100% attention and price in a premium when they think actual supply is at risk. And you can see that because there's cautious optimism over a truce, we've seen prices pare back for Brent under $80 a barrel. But the ability for that situation to really go the wrong way is absolutely possible. And if we look at what's happening with, say, the market right now, they're waiting for Iran to retaliate against Israel for the death of a senior Hamas figure in Tehran, so in Iranian soil. Now, how that plays out and what that means is where all the escalation can take place. Because if Israel retaliates to that by attacking Iranian oil infrastructure, the market can rally and can rally quite strongly. And earlier this year, when Iran and Israel were fighting, we actually saw Brent rise above $90 a barrel. So these risks are there. But until we see a key sequence of dots that we can connect and be like, yes, that's happening, oil markets won't believe it, they want to see it. And so the risk with oil, in our view, is we're talking 75 to 85, but we have positive risk all related to what happens with the tensions in the Middle East.
Vivek, thank you for talking to Fear and Greed.
Thank you.
That was Vivek Dhar, Director of Mining and Energy Commodities Research at Commonwealth Bank. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.